अरे मौका बिना फिक्र के जीने का मिल गया। 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया। जो आने वाले कल की प्लानिंग करके चलते हैं, सोच समझ कर उनको इन्वेस्ट करने का सलीका मिल गया। 12 20 और 80 से पीस ऑफ माइंड मिल गया। म्यूचुअल फंड में इन्वेस्टमेंट करने का तरीका मिल गया।
Finally balanced, active, passive, index or managed, सभी का मिल गया।
क्वांटम के म्यूचुअल फंड, क्वांटम के 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया।
क्वांटम म्यूचुअल फंड के 12-20-80 यानी 12-20-80 एसेट एलोकेशन अप्रोच ने इंडिया को सिखाया इन्वेस्ट करने का सही तरीका। और जानकारी के लिए सर्च करो क्वांटम 12-20-80 एसेट एलोकेशन। म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को सावधानी से पढ़ें।
Good evening, everyone, and a warm welcome to the webinar. My name is Neeraj Kotian, and I'll be the moderator for today's panel discussion. I'm part of customer interaction team at Quantum Mutual Fund. First, let me thank you all for taking out time on Friday evening and joining us for the session. We'll request everyone to use the headphones for better audio clarity. In today's webinar, we'll have around 30 minutes of presentation, and then it will be followed by Q&A. You all can post your questions in the chat box once the presentation is over. As you all know, the topic for today's session is on riding the big wave, how to build a winning investment portfolio for India's economic boom. Today, our fund managers will discuss key points like microeconomic conditions, possible outcomes of global economic situation, what will India's standpoint, and how will all these factors contribute to your investment portfolio. Also, they will answer the questions like, what are the indicators for the Indian economic boom? What role do global markets play? What is the potential impact on your investment portfolio? So, before I hand over control to our speaker, let me quickly introduce them to you all. Our first speaker for today's evening is Mr. Pankaj Pathak, who has over 11 years of experience in fixed income investments and research. He is a qualified CFA. He joined Quantum Asset Management Company in August 2013, and at present is the fund manager for Quantum Dynamic Bond Fund and Quantum Liquid Fund. And our second speaker for today evening is Mr. Christy Mathai, who has over 7 years of experience in equity research across multiple sectors. He is a CFA charter holder, and at present is the fund manager for Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. So without taking much time of yours, we'll request our speaker to take ahead the session. Over to you, Pankaj.
Yeah, thank you, Neeraj. And thank you everyone for joining in today. We are hearing a lot about India growth story, and we have been hearing it for a very long time. Once again, I'm going to talk about it. Most of the things you'll hear as a repeat. You must have heard it before, but we will try to add new perspective and new things as we see now. So before going to the outlook part, let's see how India's growth story has been. And as Neeraj was introducing, this slide was somehow coming up on the screen. So you can see this kind of shows the India's 20-year growth history before the COVID. So because COVID has kind of disrupted everything, and we all know how economic activity was hampered. We are not going out of our houses. So we have kind of excluded that part, and we'll discuss it separately. But we kind of opened our economy in 1991. There was big liberalization and privatization drive that started and carried on by successive governments over the last 30 years. Fruits of most of those reforms started coming in sometime between around 1995, 96. And then we were struck by East Asian crisis. Then early 2000s, we had again a global recession in 2001. There were two severe droughts. So all those combined actually kind of hampered the growth. The early pickup, what we saw, that was dampened by early 2000s. So at the starting point, you can see very low growth in India's GDP. And then the India's growth story started. The entire, if you remember the entire brick mania, where people were betting very big on brick, so Brazil, India, China, and Russia. So this was the part of the brick mania where the entire global economy was booming. India was also booming, but obviously the narrative was even stronger. So that was the highest growth we had in that phase between 2003 till 2011. In between, there was a dip because of the global recession, global financial crisis when Lehman Brothers collapsed. So overall, this was a high growth period, but most of the bad decisions are taken in the good times. So we also had our share of mistakes during that time. So corporate balance sheets were kind of levered up to a level that became a problem. Banks also took a lot of risk betting on this high growth phase to continue for a very long time and kind of face bad debt problem later on. Similarly, during the financial crisis, government also extended their debt and kind of expanded their debt and borrowed a lot to provide fiscal stimulus. So all those combined led to kind of macro vulnerability for the India's balances or across all the balance sheets. So be it corporate balance sheet, which was highly levered, banks had high non-performing assets. We were running very high inflation. So our retail inflation was north of 19% during that phase. So again, when we were struck by a shock from global market, when US Fed started withdrawing liquidity or just announced that they will withdraw liquidity, we faced a lot of problem. We were kind of classified as one of the fragile 5 nations. And that time, again, we saw drop in our GDP growth. But as we have already done, we again try to restructure most of the balances. Since then, we have restructured. We brought down the inflation. There have been a lot of reforms to control inflation, which were undertaken during this phase. We brought down the current account deficit. There were a lot of current account deficit was around 4% or higher. And that is now at a much comfortable level, very close to 2%, lower than the amount of capital that we receive every year. Similarly, corporates also gone into a big deleveraging cycle, and banks also kind of cleaned up their balance sheet. So we'll go through all those things in the latest slide. But that all these steps actually lead to recovery in growth. And then we had a big shock of demonetization, and then GST, which kind of faced a lot of glitches that time and kind of hampered the economic activity. And then the IL&FS crisis in 2018. So again, before COVID, our growth was slowing down. We had a very low growth for very long period. So if you see this big drop in growth before COVID. And then obviously we all know how COVID impacted the growth, and we are still recovering from it. You might have heard or seen those big numbers of GDP growth in the last 2 years, but those numbers were because we compared this GDP in year-on-year terms. So when last year was very low, obviously you'll get a higher jump, even if you get to normal or slightly below normal, and that's what has happened. But if we compare our GDP, our real GDP, to the previous trend before the COVID, the trend at which GDP was growing, we are still significantly below that trend line. So if we take it before FY19 growth trend, we are somewhere close to 9% below that trend line. So yes, there are some permanent damages done by the COVID to our economy, and we are still recovering from that. In nominal terms, our GDP looks far better, mainly because we had a very high inflation in the last 2-3 years. So, but in real terms, we are still recovering from that pain. So overall, net basis, our GDP is still recovering at a very slow pace. We have not yet fully recovered from the COVID shock. But there are a lot of things happened over the last 5-7 years, which kind of makes us more excited about the future. And as I mentioned, we corrected a lot of our past mistakes. So first, growth hurdles, if you see, we have been crossing across building infrastructure or cleaning up bad assets, that's going to have a positive impact on future growth outlook. Now, if we look at big thesis, again, you must have heard about this India being low per capita income country, and that gives us better potential to grow. If your base is low, you can grow at a much faster pace. And we have seen that in India's track record over the last 20-30 years, India has grown by 6.5% plus, and that's a reasonably good growth for a country of this size. Again, the big point here is that now we are at a level where additional income growth will lead to change in our spending pattern, and that has a multiplier impact. Now, we are still at $2,200 per capita income country, and most of our spending is going toward sustenance, just for survival, into food, normal housing, education, all those things we just want to spend just for survival. Now, as we grow, as we get more income, we will see spending pattern changing more to a discretionary consumption, where people buy things like maybe automobiles, fridge, TVs, all those things, where they have some discretion. Now, these things have higher multiplier impact, and that creates more economic growth as we go along. So as our income grows from here, we'll probably see higher multiplier coming in for our GDP growth. And that's in a way positive sign for the future. And we have seen that happening across all other economies which have been at this stage sometime in the past. Another positive driver which has been in India's favor for a very long time, still remain in India's favor, is the work or our population, or our young population, the working age population. It's still growing, and we are kind of now most populous country, and this has been in talk for the last 2-3 months. There have been a lot of things written about our population and our working pool. Now, big change is that till now, China was kind of gaining more on this population front, and India was kind of lagging in a way. But now what we see is that China's population is declining, and that will be declining at a much rapid pace because of their one-child policy in the past. So there we have this advantage, this demographic advantage will continue, and it can actually increase. We might see higher participation in the global supply chain because of this young population. So the normal growth driver, the natural growth drivers of India, that remains with us. We don't see any kind of sacrifice there, and probably it will multiply more in future. Now, so if I talked about in the last growth cycle, we kind of face many problems, and another thing that we faced during that era was that India has an infrastructure shortage. India, we didn't have much power. Our roads were not that good. Highways, we were lacking. So all those things, successive governments have worked on that. We have seen rapid expansion in all the rail networks, road networks, be it highway or state highways, or even in the rural road. If you travel now, you can see those improvements. And this physical connectivity has a significant multiplier impact on economic activity. So when you connect two villages, you see trade increasing, and that has economic impact. Similarly, highways, railways, that has brought down cost of transportation, cost of logistics in India. And that has been the biggest problem. Even earlier, India's workers are equally skilled as China, but our logistic cost is much higher than China, and that's what kind of putting us behind. Now with this work, and probably we'll see this expansion continuing in future. So over the next 5-7 years, you'll see this chart even going higher. So this railway network or the road network, because there's still there are a lot of investment happening. There is still a lot of projects which are underway. So all those things are positive in a way. We have chance to become part of the global supply chain, and you see that in the corporate commentaries now, what we get from many of the multinational companies. Similarly, from trade point of view, even the port capacity that has expanded a lot, and it improved the efficiency. You can see it in the average turnaround time from ship coming to our port and turning back. That time has actually halved over the last 10 years. So we are getting very close to parity with many other emerging economies which have been part of global supply chain. So now we have real chance of getting into that, exporting to the world, building for the world. So that's a real positive for India growth story. Again, the hurdles, as I mentioned, we developed a lot of vulnerabilities in the last cycle, and we kind of was correcting it for the last 7, 8, 10 years. And now you can see our corporate leverage debt on the corporate balance sheets are at multi-years low, in the lowest in last 20 years. And at the same time, we are seeing now return on assets are increasing. So that's kind of positive for investments. If corporates have low debt, so they can leverage their balance sheet now, and they have real advantage of putting capacities, investing, because now their returns on those assets are significantly higher. Similarly, if you look at the bank's balance sheet, even the financial system, that is also sitting at a very strong position. So we had a very high NPA, a lot of bad debt accumulated in the last growth cycle. And over the years, we have kind of corrected that bad debt problem. And now NPA levels are much lower. And at the same time, our capital adequacy, banks have a lot of capital. So they have that risk capital, what they can use for funding the next growth cycle. So corporate balance sheets, corporates are in good shape. Our financial system is in good shape. We have now better infrastructure, in most cases at par with most of other countries. And that's a kind of a foundation, very strong foundation we have as of now. So you can see that push coming in from government also for capex. As I said, now we have real chance of expanding capacity, and because government has been spending a lot in building all these road, port, railways. Now we see even private sector coming in, and in the last few quarters, we have seen private sector project announcements or investment announcements that has been rising at a very fast pace. So we expect this to continue. We will see probably more investment coming in, as it was kind of hampered for a very long time because of these stresses, balance sheet stresses. And now, as we have corrected, now we'll see probably more investment flowing into economy. Also, there is a positive sentiment around India. Means India has been kind of in global narrative for a very long time for both good and bad reasons. But now we see that in numbers, or the foreign direct investment, where people setting up capacity or investing into early stage companies, or taking substantial portion in companies, that has been rising. That has been rising substantially, and you can see how it has trended over the last 20 years. So when we opened up, allowed FDI in many of the sectors, we started getting maybe close to $5 to $7 billion a year. for the early phases of 2000s. And then as we opened up more sectors, we pursued more liberalization, implemented more reforms, the FDI flows increased, and it rose closer to $20 billion a year. And then you see that how it has risen in the 2014 to 18 phase. And now we see a next big jump where we are kind of getting close to $45-50 billion net FDI every year. So this year we have some dip because these cyclical factors where US and many other part of the world, advanced economies, they are kind of hiking interest rates, and they have very high inflation, hiked interest rate to very high levels, and that kind of hampered this capital flow into emerging economies. But as we move ahead, and as this inflation comes under control and things calm down, we'll probably see FDI rising even further. So that's another positive sign where people are getting excited to fund Indian investment, Indian businesses. So overall, this was the foundation. We are kind of sitting on a very solid foundation to grow at a faster pace. And we see some early trends which kind of giving us even more hope. So one big positive trend is our trade, increase in our trade, both for goods and services. So after COVID especially, kind of world realized that you can't rely on China too much. And then they started hunting for option, and India became an obvious choice there. And we have seen exports rising at a very fast pace. This has been the key driver of our growth recovery from the COVID. And we expect it to continue in future. So goods exports across many sectors, many products, we have gained market share, and probably we'll see more market share coming to India. And you can also see, so one anecdote could be, recently we have seen Apple setting up facilities in India to build iPhone, or also they open up a store in India. So building iPhone in India, and they will be selling it across the world. So that can boost export of electronic goods from India. And similarly, we see a lot of traction coming in various industries. The PLI scheme that has also attracted some interest from many of the large MNCs and even some local businesses to produce and export. So overall, we should expect this export growth to continue in future. Another, I would say, more exciting part is the services, because this has been our forte. We are kind of expert in it. So in the last globalization cycle, the whole idea was to produce at a lower cost, move to countries where you have cheap labor and you can produce at a lower cost. So it was more of a goods globalization, and China and many of the Southeast Asian economies, they actually gained out of that drive. But India capitalized on services export. We moved into earlier BPOs and then in software and started exporting. And our Indian IT industry has grown at a phenomenal pace. It created a lot of employment and has a huge multiplier impact on overall growth. So services export, that has been our forte. And now we see globalization of services. There's a second round of globalization of services that is coming in, and India is well poised to gain from it. So we have seen many of the multinational companies setting up their back office operations, even their R&D operations, many of the consultancies in India. And India kind of, so this is called Global Capacity Center, or GCCs, and India account for more than 40% of these GCCs around the world. And that's a big traction. And that's what we see in the numbers, where our export of services has risen exponentially over the last 2-3 years. And expectation is that this trend will continue. We might see globalization of globalization in terms of manufacturing capacity or goods, that might slow down or kind of stagnate for some time, while globalization of services will probably see exponential growth going forward. And that's a real opportunity for India. We have that skilled labor which can become a part of that value chain. Another positive trend or big development over the last 5-7 years is the digital connectivity. So first we had a communication boom, and then now we had an internet boom, and that kind of provided a big platform for all the entrepreneurs to build over it and address a lot of issues what we were dealing with. So you can see all the new age entrepreneurs building things around even public services to e-commerce, health, education. Everywhere you'll find some or other business, and you can see it very easily. It's visible around us. So that's another big opportunity. There is a new economy, new India, which is kind of running along with the traditional India, and along with the physical infrastructure, physical connectivity. We can also see this digital connectivity. Again, this kind of improve efficiency. It has a multiplier impact across the board. So you'll see these markets, because see, India is a huge market, but the market is fragmented. You'll see if you remove the big centers with very dense population, you'll find large part of India is living in rural areas, and there you find markets maybe 7, 8, 10 kilometers from the village, and most of the time you find these markets are very fragmented. Now with the digital connectivity, and you can easily see how even Flipkart or Amazon, these guys have gone into tier 2, tier 3 cities or into villages. And as they expand, they kind of connect those markets. And as the markets are connected, you'll see that efficiency improvement. And that has again, multiplier impact on the overall economic growth. So all in all, I think that foundation is set. We see some early trends of economy ticking up. And this could be a very long-term trend. We'll probably see. I'm not talking about a year or two. This is something which can continue for a very long time. So last 5-7 years have been bad for India's growth. We had a rapid formalization which kind of hurt the informal sector. Then we had a COVID, a lot of other shocks which kind of brought down our economic growth, and we have been growing below our potential for some time. But now for the next 7, 8, 10 years, probably we'll see our economy growing above the potential, or even the potential growth increasing substantially from its current level. So just to summarize whatever we have discussed till now, we corrected all the growth hurdles. We built infrastructure, and it's still we are still building that. Our balance sheets are much cleaner now, be it corporate balance sheet or the financial system. We are sitting at a much stronger position now. We are seeing very early sign of our trade participation rising. Somewhere we are getting into that global supply chain, and this China plus one move that is really helpful for India's aim to get into global supply chain. And the whole new digital economy, this is new ecosystem which is evolving at a very fast pace. So all these combined will probably see growth maybe going above 6.5% for very long time, and that has a real opportunity for investors who are looking to capitalize on that. Now, how to bet on that? How to gain from the India's economic boom if you are getting into one? So best way to do it to gain from economic growth is to bet on equity, have ownership in that growth story. Now, just to have a rough calculation where we should land with that. So normally if we even assume our GDP to grow by say 6.5%, which has been a very long-term trend over the last 20, 30 years, we managed to grow by that much. And we add say 5% inflation. So our nominal GDP should come somewhere around 11.5 to 12%. And so that's the normal growth for any companies. Normal assumption is that companies will grow along with the nominal GDP. And if you can find good quality companies which are listed, are more efficient, and can grow at a slightly faster pace than the normal GDP, maybe you can add another 1 to 2% growth rate every year. So close to 13.5 to 14% growth for a listed company. And if you can build an intelligent portfolio around that, probably you'll see your return somewhere coming around 15% in that ballpark. So over the long term, probably we'll see Indian equities in somewhere around that. This is not a written guidance, just to have some rough numbers in our mind based on the growth story. Probably equities will be faring somewhere near that level. And this is what we have seen over the say last 25 years. Yeah. So over the last, so this is based on data since 1996. So we have covered almost 25 years. And what we see is the long-term average return has been close to 15%. Now, these are rolling cycles. So if you invest for, say, 1 year, you invest today and just sell it after 1 year. And this table, this column you see, that is investment up to 3 years, where you invest today and hold it for only 3 years. And we see how this has panned out. Now, as I said, the best bet on India growth story is to own equities. But the problem with equities is that it is volatile. So you have to have a longer holding period. And that's what we have seen over the last many, many years. So in even last 25 years, if you hold for 7 years, there's no instance of negative return. You manage to generate positive return across all the cycles. And if you are holding for, say, 1 year, probability is that there is maximum return what one can achieve or had achieved was 99% sometime. But you can also see a big drop in your portfolio value, and that to the extent of 50%, more than 50%. So as I said, for equities, for short term are not a very good option. But if you have a long holding period, you can bet on India growth story for long period. Then obviously equity becomes an obvious choice. But from a portfolio point of view, you should have large part of your portfolio going into equities. But you should always diversify and have other assets which can deal with the short-term fluctuations. And if you need money in, say, short term, you can maybe rely on that part of the portfolio, or just to have stability in the portfolio, because even portfolio fluctuation can have a psychological impact. So it's better to have a diversification across asset classes, own a large part in equities, but have exposure to fixed income, some part in gold and other asset classes, just to have a diversified, stable portfolio. So with that, I'll hand over to Christy, who is a fund manager for Quantum Long-Term Equity Fund. And he will take you through more near-term things and how they are managing the equity part of the portfolio. So Christy, over to you.
Yeah.
Thank you.
Thanks, Pankaj, for that perspective. Just talk about equities and specifically long-term, quantum long-term equity in that context. So even as Pankaj put that perspective of India is well positioned in terms of basics, functional structure in place, and it is well poised to kind of ride an economic upcycle as and when it happens. And we are kind of seeing the early signs of it. But it'll be good to get some more perspective on how equities have kind of behaved over the last 10, 15 years, and the lessons that we can sort of drive from that. So this particular chart kind of captures how the Sensex returns and EPS have kind of behaved in the, going back to 2005. So if you see the first chart that is on the left, we see a reasonably high correlation. The Sensex returns kind of follows what the EPS growth has come for the underlying companies. And if you look at broadly, if you were to just combine all these and look at a 20-year perspective, so the EPS growth and Sensex returns are closely in tandem. Maybe there is a difference of to the extent of 2 or 3 percentage points, but broadly it has kind of tracked together. But if you see the period between 2015 and 2020, so there is a quite a bit of deviation, or that correlation has kind of fallen off in that sense, where the Sensex EPS returns are to the extent of 5%, whereas the returns are to the extent of 13%. And we'll go, what sort of caused that, but we also see the, in the right hand side chart, if you were to look at the Sensex valuations as a whole, the PE kind of sharply moved from somewhere 20 PE in 14 and ending up at around 30 plus 30 in 2020. And there were a few reasons for that, and I'll come to it. But what we see that is post-COVID, in a post-COVID environment, that correlation has kind of broken off, and since EPS growth is, kind of moved ahead of the Sensex returns, even as the valuations across the globe has come down due to interest rate hikes. So what exactly happened in that 2015 to 20 period, which was characterized by a slow growth, even as Pankaj alluded to? So what we see are, some of the major drivers for, the Indian economy as a whole. And if you look at the markets and the companies, so what we see is the sudden fall in capex, especially the private capex. So 2000 to 2010 was a great set of years in terms of the government capex as well as the private capex. But this period, 10 to 20, the capex suddenly for the private sector falls off to around 2%. And this impacts your credit growth, which was trending at about 22% CAGR from 2000 to 2010 to around 12%. Retail part of the credit growth still continued, but the corporate capex kind of fell. And this period also was characterized by a lot of disruptions, starting with demonetization, a hazy and a fast implementation of GST, which is kind of now getting corrected. You had the NBFC crisis, which impacted, the banking system as a whole, and also, RBI forcing a lot of banks, to recognize the NPAs upfront, through their AQR program as such. And so this led to a decline in credit growth, especially on the corporate segment. And real estate, this is a chart, highlighting the residential real estate sales the way back from 2007. So this also went through a big consolidation and a slowdown phase, in the past 10 years. And this is one of the major drivers of the economy as a whole. The right-hand chart shows, the analyst estimates of the consensus of the EPS. If an analyst is predicting how 1 year ahead a company's earnings will pan out, we see a substantial downgrade as the analyst moves through the years. This just got corrected in the year 2020, FY23, where for the first time in several years, what we see is the analyst estimate had to be upgraded, in line with the what the company was delivering, to be in line with what the company was delivering. So what we see is a change, and this was primarily driven by the banking sector, which showcased superb results in FY23. And all in all, moving away from this bad phase for the Indian economy as a whole, we like to think that we have kind of entered into a slightly better period, where we see a traction on the capex front, especially private capex is slowly starting to pick up. The credit growth numbers are also trying to, are inching along fine. This 10% might look low, but it is because, the the starting few years, the banks were very reluctant to lend because of the COVID crisis, but we see super performance in the past 2 years on the banking system as a whole. So all in all, if I were to tie it all together, all the advantage that Pankaj spoke about, be in terms of demographic dividend, be in terms of the capex cycle slowly picking up. He spoke about the IT sector, which if you were to exclude the Indian IT services, and talk about the GICs and the GCCs, which is kind of the back office for the world, they are hiring in numbers, and that is kind of supporting the overall hiring for the sector as a whole. And them being relatively higher wage earners, it will lead to some sort of a discretionary spending. So we kind of want to believe that we have come out of that phase of slumber from 2010 to 2020 that the economy was in, and it is sort of in a new wave of growth. Also, what I like to show is the actual numbers. So, projections can be off, and we have seen that projections can be off, as I just highlighted in the chart that I showed you about the consensus EPS. But these are actual numbers. Even if you were to look at the correlation between the per capita income in various phases and the underlying industry growth. So I've included several industries, be it banking system, the building materials, the auto sector, the FMCG, the more discretionary spendings in durable sector, as well as auto sector. We see that even in a very bad phase, that is between 10 to 20, especially the period between 2015 to 2020, the underlying industry still grew, barring maybe autos. For example, the retail credit grew at around 17%, despite the the mortgage, the residential business not doing so well. The mortgage growth was still around at 16% CAGR. The cement, here I'm talking about the volume growth, I'm excluding the pricing growth. The volume growth still came to about 6%, which is even though they might look low compared to the previous decade, but if you add to the pricing element of it, it would be somewhere in line with the nominal GDP at that point. And also the discretionary spending within the durable segment has also done pretty well. If you were to exclude the very highly penetrated categories such as fans and air coolers and so on and so forth. The auto is the only exception. The auto is an exception because 2019 was a phase of the emission norm transition. So there was a lot of pre-buying that was built in. So the the auto numbers across the board kind of fell through from a cliff in 2020. So that's why the numbers look bad. But all in all, what I wanted to say is, if you were to think of the next 5 years being better, from a per capita standpoint, and there are reasons to suggest that it would be, we should see the underlying growth in majority of these sectors come through. The growth here is probably democratic across the sectors, but in terms of stock selection and the companies do well, most of the times the benefits accrue to very few, especially which are more organized in nature. So all in all, if you were to think about the next 5 years, 7 years, in terms of India being able to generate better per capita income, more growth, as the evidence suggests, the underlying sector should chug along well, right? And I'd like to highlight, some of the two sectors that we are also kind of quite bullish on in that sense. First being the banks itself, the whole financial space. The chart on the table on the left is a long-term trend in terms of how various parameters for the scheduled commercial banks have behaved, over the past, let's say, 17 odd years. And what we see, the major components of the credit growth for the banks are the corporate, which is highlighted as the industry part of the mix, and the retail mix, which includes, your personal loans, mortgage business, auto, and so on and so forth. And what we find is, there are, in some phase, the industry does well, especially during the phase of 2005 to 10. But then there was a sudden slump that we saw in 2010 to 2020, especially with the 15 to 20, that was the year. And the retail has kind of sort of picked up from 2010 and henceforward. But it is also very important to know that the returns that they make on the incremental lending, or the book that they underwrote, it was to the extent of the average ROA and ROE during the 2005, 10, 15 period were somewhere around 1%, and ROE maybe average would be around 12%. But this dramatically fell to 0.2 and 1.2. These are, abysmally low numbers if you were to think about the organized, scheduled commercial banks that India has. And the case is because of course, lower growth and the high NPA recognition that the banks had to do. We see the GNPS across the board shoot up during this phase. Now, incrementally, this is post-COVID, and what we have seen is the numbers are improving. And if you were to include the FY23 numbers, these numbers actually go off the charts. I've not put it because some of the companies are yet to report in terms of the results. But this, so what we see is growth, of course, on the retail part, and also the industry growth is kind of coming along, which is bolstering the credit growth. So it is quite possible that the ROA and ROA slump that most of the banks had would kind of recover as the economic upcycle picks up. Now, of course, again, we have to be extremely selective within the banks, as has been our experience in the past cycles, that banks can lend here and there, and you would have bad underwriting going on. But we do not see current signs of anything of that sort emerging within the banking space. So that makes us kind of quite hopeful and bullish on the banks as a sector. The other part I would like to touch upon is the discretionary spending, especially in the auto part. So again, very long-term charts which highlights the various sub-segments within the auto pack, which includes the two-wheelers. Here one can have the economy, the premium range, and so on and so forth. The passenger vehicles, the tractor segment, and the commercial vehicles. So our portfolio is kind of present in most of these segments, but we are extremely bullish on the two-wheeler segment, also on the economy end in that sense. Because if you were to think of the volumes, this is the long-term volume chart, from 2000s. The two-wheeler volumes have suddenly fallen off the cliff from FY19, when the emission norms came into force, that is BS4 to BS6 transmission. And since then, the volume recovery has not really happened. It was hit by COVID, a lot of, there was an inflation impact, and so on and so forth. But what we find is, the public infra in that sense for India, for an average Indian, is not so developed in many of the states that many of the states in the country. And the prime way that a average commuter commutes is by two-wheelers. And at best, we have seen a replacement demand, that to tepid replacement demand since this fall in 2019. And we believe that as the volume recovers, which in due time should, there should be a re-rating within the entire space. And especially the multiples that some of these companies are trading at are decadal lows, with high cash flows, and high FCF generation and cash flow generation. So that kind of makes us quite positive within the two-wheeler space, while we are also present in the other sub-segments which are kind of doing well. So lastly, we would like to believe that our portfolio, as it is constructed, is well poised to take part in the economic upcycle due to various factors. Of consumer discretionary is essentially our auto overweight that stands at around 17% in our portfolio. Financials, which includes majorly banks, but we also have a decent chunk of NBFCs, as well as some position in the brokerage, general insurer, which we believe even as that per capita story plays out, these have long-term tailwinds for them to grow. We are kind of overweight on the IT also, which has kind of suffered in the past few months. And we believe these are still extremely high cash generating companies with global efficiency as a moat, efficiency play as a moat across the 1,000 Fortune companies. And the valuations here, of course, has come down quite a bit during the past few years, and that makes us quite constructive. And on the utility space also, we have select PSUs which we think we should do well. So that's broadly it. And while we are presenting to you the value portfolio, it is also which has a equity allocation, which takes care of your kind of an equity allocation. But we will also want to stress upon the importance of asset allocation, as you would have heard multiple times from us, that along with equity, we need to have the gold, which is kind of insurance in our portfolio for the things if they turn bad, and our liquid fund, which takes care of the 12-month of expenses, living expenses, if any catastrophe were to struck. So from that point of view, we have developed, as many of you know who are long-term investors with us, we have developed a very simple and intuitive dashboard that is present in our website. So you can select the type of investment that you want, either as active, passive. You can denote, put in the amount, that you want to allocate as investments along with monthly expenses. And you can just play around with your allocation. For an average investor, we think 12, 20, 80 makes sense, but that can be tweaked according to what stage of life a person is in. And, you can just play around, and it's quite intuitive and, easy to navigate. So broadly, I'll just stop there, and over to you, Neeraj. Probably we'll take questions after this. Yeah. Thanks.
Thank you, Pankaj and Christy, for your insightful presentation. We'll request all our listeners to post their questions in the chat box. In the meantime, we have already received a few questions via email before the webinar, or also in the chat box. So we'll start that first. Pankaj, my first question to you. What will be the impact of withdrawing rupees 2,000 denomination currency note in the market?
Yes, so one important thing in this episode we need to remember is that it will remain a legal tender. This is not demonetization, right? So if you remember in 2013-14, there was a big drive where RBI was withdrawing all the notes printed before 2005. So it seems something like that. Probably we'll see some money coming into banks as a deposit, and much of it should be kind of exchanged with the bank. So exchange note will not have any impact. Well, the money which come into bank deposit, that has some impact. So one impact would be it can bring down the short-term interest rate. So if banks have higher deposit, they have to maintain first SLR on that. They have to buy up to 18% of total deposit as in government securities or eligible SLR securities. So we'll see yields coming down. And also because of the liquidity, if you have a higher liquidity, that has positive impact on short-term bond. So short-term interest rate, you might see that declining. And in a way, it's positive for banks, even if you consider bank as investment, because big struggle for banks in this year was deposit. So most of the banks, or if you see credit growth, that was in high double digits, so 15-16% kind of credit growth, while their deposits were growing at 8-9%. So many of the banks were kind of forced to raise their deposit rate. Now, with if they get some deposit coming because of there's this note exchange, probably that will give them some cushion and allow them to expand their margin and don't need to hike deposit rate. So broadly, it will have some positive impact on banks, and will have some downward movement in short-term yields. But we don't expect a very any significant amount coming into the banking system in form of deposit. Probably will have something around 50-60,000, but not more than that.
Thanks, Pankaj. The second question to you is a couple of questions asked by one investor. Like,
Sorry. Just to correct myself, it's 50-60,000 crores, not not
Okay.
thousand.
Okay. So there's a couple of questions from one investor. Like, without growing GDP, how corporate are gaining? Is it cost cutting only? And there is again on the digitalization, same customer client has asked the questions. Again, this digitalization is mode of expenditure. What about growth in terms of money? You can answer one by one.
Yeah. So I think Christy can add on that how corporates have actually improved their balance sheet. But if I have to give a broader perspective, this has been a very long drive for deleveraging corporate balance sheet. So if you remember, our NPAs or the bad assets, etc., peaked sometime around FY13, FY14. So, and since then, it has been declining where almost the banks were more into recovery mode and corporates also kind of consolidating their work. So in the earlier phase, they kind of expected higher growth to continue for a very long time and made many of the decisions based on that, investment decisions based on that. And since then, we have seen investments slowing down in a big way. So you kind of spread the pain, and that's what has happened. They spread the pain over multi years. And then we had during the COVID, where they had a lot of savings. So we saw all the commodity prices coming down. They were most of them operating from home. In many cases, their efficiency improved, and they had a higher margins running that time. So overall, they kind of it's a mix of these things. One is the distribution of pain and kind of staying away from fresh investments for a long time, and also some cost saving. So both sides have played. Christy, if you have anything to add.
Yeah, just to add that, if you were to look at, the Indian promoters, how they've evolved over the past, 15, 20 years. So there was a lot of dependence on bank debt, at that point, let's say 08, 09, 010. And some of those, the IRRs of the projects and so on and so forth that was built in did not come through. And as a result, at some point in time, they had to, so it was declared as an NPA by the banks. And of course, there was certain part of the economy where there are a lot of malintentions in terms of just defrauding the bank itself. But over a period of time, of course, what we have seen is the banks getting smarter in that sense, especially the private banks in terms of lending, very strict guidelines. Also, there are so many mechanisms where RBI has, perfect control and watch over, which book is behaving at real time. Those things were not there at that point in time. And so as a result, of course, the bank is, if you look at, how corporate debt has grown over the past, let's say 8-9 years. So we see banks incrementally lending more to AA, AAA plus rated corporates, and the junk category is in fact not getting much, in terms of debt, even though they may be looking to raise. So that's one point from a bank perspective. But from the corporate perspective, they also now know, how to, raise money more efficiently. When the valuations are on the higher side, they might raise it from equity, doing a QIP, and so on and so forth. And they also, with low interest rate environment globally, they know how to tap into the global overseas market as such. So in that sense, the both sides have progressed in that well. So which has kind of resulted in this corporate deleveraging over a period of time. So that has kind of helped, I would say, the entire corporate part of it. Yeah.
Thanks, Christy. Thanks, Pankaj. Christy, next question to you. Is it all for real or overhype, like creating a big bubble by blowing up the propositions to sound a positive economy? Because we saw something like this in 2007, 8, and 9. So is history again repeating sooner? What's your view on that?
Yeah, it's a very valid question in that sense. So if you were to see broadly, what we are really saying is, when we used to go to, meet companies in 2016, 17, 18, that period, so we come out pretty negative in terms of what's happening on the ground. But what we see now, makes us more positive. And it is, in that sense, not a hype to that extent, because what we are really saying is the normalize the cycle which turned southwards is kind of now normalizing, just coming up from the doldrums. So in effect, what we are seeing, this economic upcycle is just the normalization of, just coming to mean in terms of where the potential, of the country is. So in that sense, I would not characterize it as a hype. It is just reversion to mean in that sense, because you went through that cycle of 10 years of absolutely, poor performance. Now it's just coming back. So, and if it were to come back, what are the implications in terms of stock selection, industries where we see growth? So I just like to leave it at that. Yeah. Pankaj, anything that you want?
Yes. So just to add, if you remember that time or the entire narrative about growth during that time around 2006, 7, 8, I clearly remember if you quote 6% or 6.5%, even 7% GDP growth for the next 10 years, you will be at the lowest end of the economic growth forecast for India. Most of the growth forecasts were at 8, 9, 10%. So it was kind of overexcitement, some kind of mania where people kind of extrapolating that high growth phase for a very extended period. But now, if you see, you find the growth estimates more reasonable, something what we have achieved in the past, in the past 20, 30 years. If you take the average growth rate, that will be somewhere close to 6.5. And given how we have improved our infra, given how our balance sheets are constructed, even our social parameters. So I would say even the progress on the health and education front, the workers are better skilled and now. And you see all the digital courses, all this ed tech, who are benefiting most. You see the re-enrollment in most of these online upskill courses, you'll find it is mainly Indians who are driving that demand. And you find a lot of Indians pursuing that. Even the contribution is highest from Indians. So all those things are in favor, which can actually give us a little more push above 6.5. But yeah, we are not talking about 9% growth from here. We will be more happy even if we grow at 6.5, 7%.
Next question, anyone of you can answer, like it is on the taxation changes which has been done recently, like for quantum multi-asset fund of fund and quantum equity fund of fund in particular has lost their charm as a solution for the investors' needs. Is quantum looking to alternate as a migrate or impact on tax changes?
So
mitigate the tax changes, yeah.
Yeah. So I'll give two perspectives. One is that see, the idea of the diversified asset allocation, I think that still remains. So with tax or without tax. But yes, we are looking at it. We are still working on that, on the process. So maybe sometime in future you'll hear from us. But as of now, we are in the process of reviewing both the funds.
Pankaj, next question to you. Will the global recession affect India in near future? What measures India is taking to control inflation? Given the huge population ahead of China, how many unemployed in India?
Yes, so this is actually three questions. So I'll go one by one.
Yeah.
Now, first on the global recession, yeah, we hear a lot about recession in many parts of the world. So especially in US and Europe. But if you look at data which is coming, especially from US, it seems recession is little far. But even if we have, yes, there will be some impact. There could be a minor impact, but we always have bounced back very sharply from those downturns. So there could be a blip. We might face some some dampening of growth, maybe in FY24 or maybe some part in FY25. But overall, over the next 5, 7 years, 10 years, I think this will be just a blip. So it should not have much impact. On the inflation front, so my view has been little different. So if you have followed our commentary on the fixed income side, our opinion is that inflation that we saw over the last 2 years, that was mainly driven by one of price shocks. It was not inflation. So inflation is something where your prices are growing at a certain rate for a sustainable period. Now, what we saw in the last 2-3 years, there were supply chain disruption because many of the economies were not operating at their full potential. Trade activity was kind of hampered. And also then we had this war shock, the Russian shock, where commodity prices spiked up, and suddenly we saw crude or petrol, diesel prices, etc., everything moving higher. So a mix of these two actually kind of led to higher inflation. And now we are seeing that coming down. So our expectation is this year probably will have CPI inflation below 5%. So for us, this is a very manageable level. We have lived with that inflation. And if you see even our expectation, long-term expectation, we kind of put our expectation for inflation closer to 5%. So I think this is not a cause of worry for now. And we don't see any structural sign of inflation rising significantly from the tolerable levels, I would I'll say. So I think inflation, we are not doing anything, but yes, RBI has reversed the monetary policy. They gone to 4% on the repo rate during COVID crisis, and they pumped in a lot of liquidity to the extent that at one time banking system was sitting on surplus of around 12 lakh crores. So they reversed those accommodative measures. Now they are back to 6.5% repo rate. And now if you look back in history, we are very close to the average repo rate over the last 20 years. So they kind of normalized the policy. And also liquidity front, they came closer to normal, slightly in positive. We still have some surplus lying with the banking system. And probably that will continue for some time, but not like 12 lakh crores what we had in 2021. So I don't see any significant jump in interest rate or any drastic measure to control inflation at this juncture. And third question, sorry, I forgot the third question. Can you come up again?
Yeah. So given the huge population ahead of China, how many unemployed?
So unemployed. Yeah, so employment has been a problem in India. So especially in the last 5-7 years. Now, I have to just, there's a lot of discussion about employment. There are two sides which kind of always debate whether there is unemployment or no unemployment. Now, we fall in the camp where we see that unemployment increase, especially after 2016-17, and that phase continued till now. Now, why it happened? First, let's look at that part. So in my presentation in the first slide, I mentioned during 2016-17, we had multiple shocks. And if you look at the nature of those shocks, it has something peculiar. So one, the demonetization. So your cash has gone out of system, right? Even for a temporary phase, cash was not available. And India is a big informal economy. We have almost 85-90% of our economy is informal, unorganized sector, which mostly deals in cash. Again, we had a GST coming in 2017, which was kind of, so GST over the long run could have a very positive impact. Formalization over the long run has a very positive impact. But formalizing the economy with a shock, very rapid formalization can have a negative or devastating impact for any economy. And we have seen that in different countries as well, where they had a similar process at some time in past. So mostly when these things happen, you see businesses moving from unorganized sector to more formal organized sector, where big companies get bigger, but smaller are crushed. And now the efficiency level or the labor intensity for big companies is far better than the unorganized smaller companies. So they can produce same level of units, with a much lower labor deployment than what unorganized sector was doing. And that created a lot of unemployment in the economy. And that phase continued till now. We are almost 5-7 years. And you look at other shocks as well, be it the NBFC crisis after IL&FS, because who were borrowing from these NBFCs, especially the smaller NBFCs, the unorganized sector. We also not getting funding from scheduled commercial banks. Or during the COVID, means these are the guys who have to go to work in their factories and go there physically. So they're not have the work from home facility. So all these shocks had a disproportionate impact on the unorganized sector, and that is 85% of our total employment pool. So we saw that declining, total jobs declining, and now we are still sitting with that problem. Though now we see some improvement, and recent data was really encouraging. Means we see that in the unemployment number, which has risen, and that gives a negative perception. But why it has risen? Because labor force participation has increased. Now we see more people coming back into the labor force who had left the labor force earlier. So that's a positive sign. That's very encouraging. Also, we are seeing some activity improvement in the informal sector. We are seeing pick up in the construction sector, which is a very large employer for low-skilled, semi-skilled laborers. So all those things give us some hope, some positivity that at the broader level, employment situation is improving. But yes, we are far from where we should be. And even with maybe 6.57% growth, we won't be able to address that employment challenge properly. We need to grow at an even faster pace to have a proper employment for our young population. Yeah.
Thanks, Pankaj. Christy, next question to you.
Yeah.
Why EPS growth of Sensex in 2015 to 2020 was low and still return came, meaning very high PE multiples? What were the reasons for high PE multiples?
Right, sure. So 2015 to 2020, that period was again characterized by ultra low, interest rates across the globe. And in a way, if you really look at the consensus chart that I showed you, so there was a lot of growth that was built into, every year. And somehow investors came back disappointed after the year, but they were able to prop up because of these, the cheap liquidity gushing around the world. So that came into India, and as a result of it, the PE across the board shot up. And if you also were to think of the companies which kind of did well in that period of time, majority of them would be, let's say, in the expensive pockets, something like an FMCG, something in the paint segment, even in consumer durables, which were reporting marginally higher volume growth. And some of the companies on the cheaper end of the profile, were completely neglected, and there was no valuation accorded to it because they were kind of suffering. So marginal growth was also accorded with very high premium valuations. And this was not only in India, but across the globe. We keep hearing of the FANG stocks, which kind of did extremely well. In US, a similar thing is spoken about the Chinese internet names like Tencent, Alibaba, Baidu, and so on and so forth. So across the world, this low ultra interest rate environment, kind of propped up PEs wherever there was growth. It was more money chasing growth at that point in time, which we think has reversed quite a bit, post-COVID, even as the interest rates have kind of risen quite rapidly. Yeah.
Next question, Christy, is why second-hand vehicle sale boomed?
I assume you're referring to the CV cycle within the auto. There, of course, there was a boom that happened. I think there were certain rules which are kind of changed in terms of axle norms and so on and so forth. So that kind of helped with the second hand. But we own a NBFC which caters into that specific niche second-hand vehicles within the CV space. So the volume growth kind of is a bit muted in that sense. It is just picking up. But also what we find is because, of this inflation pressure, the OEMs increasing pricing, so the replacement cycle across the board has also kind of elongated a tad bit, especially in the two-wheelers. So that has also helped. Either people are, holding on to what they have, they're not purchasing new, and in some cases they pass it on to somebody else. So both of these phenomena have been observed within, various segments within the auto space. Yeah.
Thanks, Krishi. There's a question on IT sector, like why overweight on IT services? The
Right.
growth potential is coming down materially
Right.
while valuations are still high.
Right, sure. So, I just like to, take through what the fund has done with the IT holding, because it is, kind of our overweight position for quite some time. So, we built our positions into the IT services way back in 2016-17, where people had kind of written off Indian IT services. I remember our weight was somewhere in the single digits. We kind of moved up because, and there were a lot of things being spoken about at that point, that the people, especially the large labor pool, would not be able to be retrained in the new skills. In that time, it was analytics and the cloud and so many other new technologies were coming to fore, and somehow there was a belief that Indian IT services would not be able to rescale, and then the growth kind of materially came down for a few quarters. We thought the IT services are essentially an efficiency play for most of the Fortune 500 companies. Even in recessionary periods, what happens is generally they cut down their expensive staffs and allocate it to IT services. That is because they're coming from a place of cost reduction, and that's why we see a lot of consolidation deals happening across the IT industry over a period of, especially in the distress periods. What we have seen in 2008, 2007, 8, was a point in case, and the early phase of COVID. So we built into these positions at that point, and at very attractive valuations, and all of them kind of did pretty well when the street, believed that the growth is coming, and the growth kind of really took off to another level post COVID, because at that point in time, the digital requirements across the companies kind of increased manifold, and Indian IT services were kind of able to participate in that growth wave. And as a result, the valuations also kind of jumped pretty steeply during that phase. Somewhere, in October 2021, if I remember, so we realized that many of these companies are hitting our sell limits, and we would like to exit or trim substantially. And we kind of did that. We trimmed most of our positions quite aggressively. Somehow, when we look at our portfolio positioning, then it is not visible, because the positions had become such large, in size, and we kind of aggressively trimmed across the board. But during the last year, where the IT index kind of went through a 20% plus correction, we thought, it would be appropriate to add into some of these positions, especially the names which have fallen quite rapidly. And we added into very few of those stocks, and hoping that things would change slowly, even as the world comes back. And that was on course, until February, March, until the banking crisis in US kind of flared up with respect to few banks which have taken inordinate risk in certain segments, blew up, and so that kind of increase the risk, taking ability in many of these banks, which are large clients of the Indian IT services. And suddenly there was a pause, in a way, in some sense, a pause in decision making in terms of allocating more incremental capital and so on and so forth, more incremental contracts. But we broadly believe the situation where we are, the valuations have come off quite meaningfully. Some might argue it is marginally higher than the pre-COVID levels. That is well taken. But we also believe that digitization trend and the need for IT just being a back office enabler to being what drives the business is also there. You just speak to the CTO or a chief technology officer in any of your firms, you would realize the importance of IT, especially within the banks. That's what we are hearing from our Indian banks also. So somehow we feel the technology intensity has increased, and the valuations have come off. There might be some near-term pressures in terms of maybe a few quarters where you might see a deceleration, but eventually this should come should come back. So we are positive from that front. But if we were to think on the hindsight, if what we could have done differently, we could have trimmed a bit more back in October, where it looked like it was expensive, and maybe added a bit later. But that's hindsight knowledge, honestly.
Thanks, Srishti. Pankaj, next question to you. You have presented a very positive outlook, but still expect growth rate to be in 6 to 7% range only, whereas in China, at its peak, was growing at about 9 to 10%. Why we don't see that kind of growth in India?
Yeah, so I think China had a big globalization tailwind that time, and that allowed it to grow at a faster pace. Even India grew at a very fast pace during that time, very close to 8%. There are a lot of things that gone right with China. They took a lot of right decisions, and that also put them at a that rapid growth path. Now we are sitting on a very favorable foundation, more like how China was positioned earlier. But again, the global tailwind is not there. We are seeing world which is kind of fragmenting day by day. So that global tailwind is not there. But yes, we have opportunity to capitalize on China's withdrawal or worse withdrawal from China. So this is China plus one moment. Now we have this opportunity. It has been happening for some time. India kind of not able to capitalize on that for last many years, but now we are seeing some traction, and India now features much more in the commentaries of these multinational companies who were earlier present in China. So we see a lot of interest, and I think foundation has been laid down, as I mentioned in my presentation. We'll probably see India picking up, but it's very difficult to go to that level unless we see more reforms coming in, say very broad sectors like maybe like agriculture, which has which caters to very large population. So if you see any material significant changes happening, especially because of this new age technologies coming into agri segment, probably we can see something happening there and improving productivity significantly. So if those things happen, probably we'll see in our growth rate taking even higher. But as of now, it's 6.5 to 7% kind of level that looks more reasonable based on overall India's position. But just to remember, this is now our base is significantly higher. We are at the same level where China was in 2006-07. So now even if we grow by say 6.5, we will be adding a lot more to our GDP every year, because the compounding will come into play. So the 6.5 or 7% is not low in this world, not by any standard.
Thanks, Pankaj. Christian, next question to you. While investing in mutual fund, minimum how many schemes and investors should invest in?
Right. So in a way, we do this, in terms of having a great set of exposures to various styles of investing through our fund of funds, where we look at different styles of investing. As our founder has always said, that value as a strategy, you may allocate say about 20% of your portfolio equity allocation to, then you should have other styles. So in terms of minimum number of schemes, so it is up to a investor to decide what sort of exposure he wants to various styles, and our fund of fund kind of does that beautifully to see different. We choose maybe 6, 7, 7, 8 funds which depict patterns of consistency, well governed, and so on and so forth. So I think somewhere that mix is enough, because over and above that, you are incrementally buying the same set of stocks, which every other mutual funds will have. So, in that sense, that is not rewarding in that sense. So at your core, you should have certain funds which takes care of various styles of investing, value being a case in point, maybe a growth or a gap strategy, and so on and so forth. Some allocation to various segments of the market, maybe mid cap, small cap, and so on and so forth. But and I think that our fund of fund kind of beautifully captures. So I think you should restrict yourself to that number in terms of schemes. Yep.
Thanks, Rishi. Next question, any of one can answer, like how an AMC are going to handle the challenges like SEBI is reducing the expense ratio, promoting index funds and ETFs. SEBI is planning to make performance-based expense ratio for active funds. So since SEBI is taking to all the steps for the investors should not lose their hard-earned money. So how are we dealing with that particular challenge?
Right. So maybe I'll go first in that sense. See, all these rules are so well intentioned in that sense for the investor, giving them working in their interest, be it reducing expense ratios, more passive investment opportunities, and the last one being performance mandate. I don't know how they'll capture it, but it's a kind of a work in progress. So it is all in investor interest to that extent. So how an AMC will manage? So if we broadly were to look at any listed AMC, they are extremely profitable in that sense. So, be it cash perspective, you look at the return ratios, they're off the charts. If you were to do a similar analysis with the other industries, within the Indian economy. So financially, they have the wherewithal to face, to see TR cut to that extent. Of course, it impacts them negatively. There is no doubt. Incrementally, what we have seen in majority of the listed companies in the listed space, that generally they pass on these costs to the intermediaries. There is a yield pressure that, of course, is there, but there is the pass on that happens to be it distributors, to be it other intermediaries such as RTA or the brokers and so on and so forth. So these are some of the ways that they mitigate, the challenge of lower expense ratio in that sense. But to my mind, all these are very well intentioned from an investor perspective.
Yeah. So I have only one thing to add. What we have seen over the last many years. So all these things, what is actually in a way well intentioned and are good for investors, ultimately they turn out to be good for AMCs as well. So I think over the period we will see even these things happening, these things helping even AMC's business.
Christy, next question is on our long-term equity value fund. We see QLT follow well-articulated approach to investing, like liquidity filter, governance, margin of safety. So today in near all-time high market, are you finding opportunities to buy with value approach?
Yeah, sure. So incidentally, like we are kind of finding quite a few opportunities. If you've just seen our portfolio, how it has behaved, the incremental ads that we have done. I think we have added a brokerage, we have added an AMC, we have added a general insurer, something in consumer durables recently, very recently. So we are finding opportunities, in various segments, and somehow with, price to, a cost of capital being higher, like, unlike what it was in the 2015-20 environment, we see some rationality in terms of valuations, and, a lot more companies are coming near our buy limits and so on and so forth. And so actually in this market, we have been able to find quite a few opportunities. So one thing to note is, yeah, the markets are now kind of moved up quite sharply in just a few days, but it is somewhere at the same level. There is a big time-wise correction that has happened in the past 2 years, ever since that COVID boom, if you were to really think of it. And valuations in some of the most expensive pockets, especially where we've been able to add something in an AMC insurance, have quite dramatically come up. Although some regulatory interventions have happened within both the spaces. But so all in all, I feel we are being able to find a lot of opportunities now compared to, let's say, our state in maybe 3-4 years back. Yeah.
Thanks, Christy. Okay, next question to you. Like, there are talks of recession in US and other countries. Will that not affect India growth negatively?
Yeah, I think we discussed about it, that recession can have a short-term impact. There will be some impact, but over a medium term, probably that will be a minor blip. So we should not be too worried about that. Even now, when I look at data, we don't see a very deep recession unless something big breaks there. So broadly, it will be very shallow kind of thing.
Christy, any view on the real estate sector would you like to share?
Yeah, so real estate, what we're seeing is, ever since the post-COVID, there is a pickup within the residential space. When I'm just talking about the, the mortgage piece. So it has kind of done well, and you see most of the developers reporting better numbers. And incremental lending by banks and NBFCs have also kind of picked up quite sharply during this phase. So somehow it's very difficult to call, but we see that this whole residential space is kind of, the growth is there is significant room to go, purely on the back that it has, the past 10 years have been so bad for the sector. And even as the interest rates have kind of risen quite a bit, it's been quite sharp increase, but there is no meaningful slowdown that we have seen within that, the residential piece, for the mortgage business as a whole. So in a sense, like, we are hopeful that this kind of growth continues. But we generally do not want to play buying, real estate companies. We either like to play it through basically financials or building materials, because we still find, some of the reporting that the developers do are quite opaque, and we are not very comfortable with, the managements and so on and so forth. So in the past, this sector has led to a lot of blow-ups, and that makes us very careful, but the growth is, we are seeing, quite a good growth in the segment, and hopeful of this will continue.
Christy, there's a question for you. Like, we have been incrementally adding positions and increasing weights in non-lending financials like insurance and AMCs, while the low penetration statistics are known for both insurance and AMC have been facing regulatory headwinds. Your view on that?
Yeah, so that's quite true. And if we were to look at some of these businesses, I was saying 5 years back, we will never be able to add into any of them, because they were quoting at sky high valuations. At that point in time, we were really studying building models, meeting management, trying to understand the business quite well. And over the past 3-4 years, what you've seen is a lot of regulatory interventions in both these sectors. So we have one general insurer that also has gone through quite a bit of changes, and AMC, as we all know, has, like, there is a complete, it's dramatically changed in the sense, like, what was there earlier. But just speaking on general insurer, we still find, post-COVID, especially, even just before COVID, when there were a lot of general insurers who got listed. So first, there was very high, competitive intensity within this entire segment that was there. Even post-COVID, it has continued. But we see some signs of that receding. Most of these insurers used to report upwards of 105%, combined ratio, which is, all the expenses put together. So they were all making losses. but we see some easing in terms of that competitive intensity, especially some of the folks who have the unlisted new players, which is backed by P money, that have entered and have disrupted, mainly on pricing front. So there is some competition which is coming off, because regulatorily also they have to reduce their spending. They have to. There is a certain grace period given of 5 years where to build business, beyond which they have to bring it in line with with the industry. So somewhere that kind of helps in terms of bringing more sanity within the competitive space. But truly, for all these companies, what really makes money is the float. If you were to really think of an insurance player, especially on the general insurance, the underwriting, it is best if they do not make losses, but we see most of them making losses. But it is the float and the leverage and the way you can leverage that and grow your book. You can earn 8%, 7, 8% for a very long period of time using just the float money that is there with the insurer, and it keeps coming, as the premiums grow, and we do not see any secular decline in the premiums. So we feel the competitive intensity is kind of easing, and this float money will lead to more profitability. And when that transition happens, so it is very sudden and it is very sharp for most of, especially on the general insurer that we are kind of present in. So that makes quite us hopeful within that space, and the valuations are, of course, one source of comfort. Within the AMC, again, by and large, what we think is, yes, there is a lot of damage which is done, and with the proposed, proposed regulations, there would be impact on the yields for most of the AMCs in that sense. But by and large, we believe they will also be able to pass on some of this, because people on the other side are making tons of money in that sense. So they should be able to pass on some of these impacts. But net, it is still negative. But I feel we have to take a very long-term view on the AMCs of how it has evolved across the globe. And in the end, when you have it all in place, you have a cash-generating machine, at very high ROE, ROCE. So meanwhile, the regulations are a bit negative. We feel there is significant potential, and the valuations is very comforting at this point in time.
Thanks, Srishti. Pankaj, next question to you. What sort of ICOR do we assume for 6-7% GDP growth?
Yeah, so ICOR is actually a capital to output ratio. So whatever money we spend and how much output it generates. And over the year, what we have seen that ICOR actually coming down. That's what we see in data. So our assumption is more normalized, which is closer to 4.5. But we all know this number can be tweaked based on how optimistic or pessimistic you are. But if you see the recent trend, it has been at this level, and it also gives us some comfort that we are kind of have some conservatism while building our portfolios, right? So so it's closer to 4.5. Yes.
Thanks. Krishi, next question to you. Does Quantum has any exposure to defense sector? How do we see growth opportunity in that sector?
So we don't have a pure play defense as a theme sector. So we used to own one company, but we had some corporate governance issues with them. So we kind of had to, leave it at that point. That was some time back. Currently, we do not have any defense as a sector, or, exposure to defense as a sector. This theme has kind of done well over the past, 1.5 years, ever since, the Russia-Ukraine war sort of started, which kind of got everybody's attention to the defense spending. And what we have seen is a rise in order book for some of these PSUs, which were, in the doldrums for many years. So we have evaluated some of these opportunities, but we do not have significant confidence, how this order book would eventually translate to revenues or cash flows for many of these PSU names. And there are few private names which are very expensive. So we have not really found, this sector to be very attractive from that perspective.
we can take one or two more questions. If any of you want to ask a question, you can post that in the chat box. So Christy, like what sectors will benefit the most going forward?
Yeah, so as I said in our portfolio positioning, we are clearly, we see if the Indian economy has to have that economic upcycle, which is kind of a normalization to long-term GDPs and growth rates. We think the financials are a perfect play to that. And, one case is because the valuation there are pretty comforting, and there are enough catalysts to move that, in the sense, in terms of growth rates. So as I showed you the ROE metrics, so that should improve going forward, even as credit cost, even if there is a, credit cost catches up next year after such benign environment currently. Um, Also auto is one, and I feel there are opportunities across the board, within the sub-segments. Two-wheeler, is where we are quite overweight because of the volumes, as I told you, because we expect that volume growth to happen in there, and the valuations are at decadal lows. So these are some of the sectors I think we are clearly, we expect them to do extremely well in the 2-3 years, going forward.
We have one more question. Like, can you please share your views on how small micro cap stocks can do going forward?
Yeah, so what we have at least observed over the past cycles is the small and mid cap rally is also extremely cyclical, and currently we are seeing some catch up in terms of small and mid, coming back. But we feel we need to really do a lot of, what do I say? We need to figure out. We need to have a lot of comfort with the management to be able to invest it rightly. And some of the key challenges that we encounter within the small and mid cap is, number one, liquidity. So we feel that liquidity beyond top 200 companies is kind of very low. And to be able to truly construct a portfolio which is only small cap and only mid cap is quite challenging from that point of view. But of course, there are quite a few good companies within the space. We have to really carefully evaluate it. And value fund, we have not shied away from looking at them. At various points in time, we have allocation to small cap, maybe mid cap names within our portfolio, as the case is now. So we would look at on its own merits individually, but as a cycle, it's of course very difficult to predict, and it is very cyclical. So you need to exit at the right point in time, otherwise it just comes back, as what we have seen in post-COVID. So we need to be extremely careful from that point of view. Yeah.
Thank you, Pankaj and Christy. With this, we will end our Q&A session. Christy and Pankaj, any closing comments from your side?
So again, I just reiterate that we see that optimism coming in. If you have followed us for a long time, we have been cautious, right? So since demonetization, our view has been on the cautious side. We were of the opinion that there is some structural damage has been done to the economy, and there will be pain for some time. And then we had some repeated shocks which kind of pushed us back even further. But now we see that optimism again coming back. So I think this is the time. Now, from portfolio point of view, don't just get excited with your full portfolio. So always have diversification, choose simplicity. And one way of doing that will be this 12-20-80, where you have some buffer for emergency, 12 months of your corpus. It could be different. So if your expenses, say you want to keep 24 months or 36 months, you can choose as you want. You have this calculator, you can work on it. Some portion in gold as a just as a shock absorber. If you see a big shock, we have seen over the past many years that gold kind of come that time as a savior. And then major portion should should be bet on this India growth story for long-term wealth creation. So just I think we should have diversified portfolio, and that's what we here to offer. Thank you.
Yeah. So yeah, so just one message. So be well diversified across asset classes at all points in time. So, that is extremely important. And don't get swayed by, just one theme as it is. So we always have spoken about it. And please feel free to utilize our website where we have that excellent dashboard to make that asset allocation construct. Thank you.
Thank you, Pankaj and Christy, for your valuable comments. To know more about our 12-20-80 asset allocation solution, we'll request all our listeners to visit our website, www.quantumamc.com. Also, further, for any queries, any questions to be answered, you can write to us at customercare@quantumamc.com, and we'll be happy to answer the same. Once again, thank you all for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.